Hello, and welcome back to Reflections on Investing with the Cornell Capital Group. And today we're going to talk about a timely topic, namely volatility. You read about volatility all the time. I hear people talking at parties and social events about volatility, but I suspect that basically none of them, or very few of them, know what it really is. So let's start by being clear on what volatility is. And what I've done here, if we go to the iPad, is I've written down the stock price of Apple for the last 5 days. That's this week. On Monday, Apple closed at 171.66. On Tuesday at 174.83. On Wednesday at 176.28. On Thursday at 172.12. And on Friday at 168.64. But volatility is not related to prices. It's related to the return on the stock. And the return is the percentage change in the price. So if we take these prices, I can calculate the returns. And the return from Monday to Tuesday was 1.85%. From Tuesday to Wednesday, it was 0.83%. From Wednesday to Thursday, it was minus 2.36%. And from Thursday to Friday, it was minus 2.02%. So those are the four returns using the closing prices. Now, what's the volatility? The volatility is the standard deviation of these returns. And I'll leave it to you to go back to a statistics textbook if you're not familiar with standard deviation. But Excel or any spreadsheet like that will have a little formula for you to compute standard deviation. When I apply that, call it STEV, it comes to 2.08%, but that's per day. In practice, whenever we talk about the volatility of Apple, or the volatility of the market, we're not talking about standard deviation in terms of per day, but in terms of per year. There's an easy way to annualize this. You basically multiply by the square root of the number of trading days, which is 253 in a typical year. When you do that, you get 33.15% per year. And that would be the measure of Apple's volatility. So now that we know what volatility is, I want to tell you about an important property of volatility that may affect your investment thinking today. To do so, I need to distinguish between two different types of processes. The first is a coin flip. If you flip a coin, no matter how many times it's in a row it's come up heads, the next flip is equally likely to be heads or tails. So a series of flips tends to randomly oscillate between heads and tails. Weather is different. If you knew today was a very hot day, then you're probably in July. And if you're in July, tomorrow is likely to be an above annual average day as well. If you knew the temperature was very cold, then you're probably in January, and future temperatures are likely to be cold. That's what's called a serially correlated series. When you're above the mean, you tend to stay above the mean. When you're below the mean, you tend to stay below the mean. So what's it look like for volatility and returns? Well, there's one more thing I need to introduce you to, and it's something called the Vix Index. The Vix Index is a calculation of the expected volatility for the Standard & Poor's 500 over the next 30 days. So it's not a historical, but a forward-looking. And there are actually contracts, options and futures and all traded on the Vix Index. And here on the iPad now, I have a plot of the Vix Index over the last 30 years. You can see that it varies between about 10%, that's the standard deviation in annualized terms, in the most quiescent times, up to over 60% during the financial crisis, and 50% during the COVID crisis, and during the dot-com crash, 40%. But notice that when it's above average, it tends to stay above average. Here, 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 and probably right now as well, though I don't show that on my chart. That's like the weather pattern. On the other hand, if we look at the actual daily stock returns, that would be just this series of numbers here, the returns, and I just plot every day, I plot the return. That's like the coin flips. The fact that it's above doesn't mean it can't be below the next day. There is no pattern in these returns. A big return today doesn't tell you about anything tomorrow. But a highly volatile market today does predict a highly volatile market tomorrow. What's the practical import of all this for you? Recently, the volatility of the market has been very high. Because volatility tends to remain where it is, we can expect over the days and weeks, maybe even months ahead, to have a very volatile market. This has been Reflections on Investing with the Cornell Capital Group.